This video focuses on what lenders and investors want. So common questions we get from business owners. Why do I need additional financing and capital? When should I start looking for funding? What are the typical sources for funding? How are lenders and investors different? What do lenders look for in my business? How do investors look at my business? Why do businesses need additional financing and capital? Well, first, you might need additional working capital to support something like sales growth, or when you have a mismatch between collections and payables, or when you've had a mismatch between payables and collections that has grown over time. You need more working capital. You might also need funds for new facilities or for a staff expansion. You want to grow your business by building new facilities. You might also need cash to produce products for a specific purchase order. So where do you get money? Well, first you have family, friends, and fools, the 3 F's. Family and friends are good places to get money. Fools, perhaps not so much. You also can have unsecured borrowings using items such as your credit cards. A little bit more sophisticated, banks and credit unions. You can issue a sale of stock in the business to attract additional investors. And finally, you can go to venture capital investors. Start at the top. Start with your family and friends. It gets tougher as you go down. Unsecured borrowings are relatively simple. Banks get more complicated. Stock sales even more complicated. And venture capital investment gets very complicated. So let's take a look at lenders. What do lenders do? They basically provide you a loan. What is a loan? They're basically selling you money, giving you money at certain terms and conditions. So they give you the money, but they're looking for a periodic repayment on the loan. You're probably going to be making a monthly interest payment, and you may be making a monthly principal payment. You may be making a monthly principal payment with some sort of lump sum at the end. If you're lucky, maybe you'll get a total lump sum at the end, but they're looking for periodic repayment, interest and principal at some point. The lenders are relatively hands-off as long as you pay. And they also require periodic reports and meetings. They want to review your financial status to make sure you're going to be able to keep paying them, to make sure the business is on the same track as when you started. If you're headed in the wrong direction, they might offer you some friendly advice, but their friendly advice is really geared towards making sure you still pay. Investors, on the other hand, provide an equity investment in the business. They're providing money for an ownership position in your business. They also require a return on their investment. Now, the details of how they get this return can be negotiated, but they're looking for a percentage return. The lender's looking for an interest rate. The investor is looking for some sort of return. We'll talk a little bit later about what those return percentages might be. Investors will probably be higher than lenders, but they want a return over a specific horizon, just like a lender would. Investors can be hands-off, just like lenders are. They may sit back and let you run your business, or they can also be an active partner. They can be a hands-on investor in your business. It's important to understand when you're seeking investors whether you're looking for somebody who's hands-on or whether you're looking for someone who's hands-off. If you want somebody who's hands-off and you get somebody who's hands-on, you may find yourself having a mismatch. And investors also will require periodic reports and meetings. They too want to keep track of their investment, and they want to keep track of the financial status of your business, which is now partially their business. So lenders and investors see you first as a potentially profitable customer or partner. On the other side of the scale, they see you as a potential way to lose money. And your job is to convince the lender or investor that you are going to be a profitable customer or a profitable partner. So what are the lenders and investors going to ask you? First, they're going to ask you, what are you going to do with the money? And it's important for them to see that the money goes into the business, not into your pocket. So the answer is, I need this in some way for business growth, new facilities, additional working capital, to fund a purchase order. Not that I've invested a lot of my own money in a business and it's time for me to cash out. That typically is not going to go over big with a lender or an investor. The next thing they want to know, do you have a plan? And does that plan make sense? Is there a business plan for new business or the business expansion? Do you have contracts, documents, etc. for the purchase order funding that you're seeking? And next they want to know, how are we going to get paid? They're going to look at your ability to pay, your willingness to pay, and any collateral that they ask you to put up. So what should you be doing? Well, first prepare before you meet with a lender or investor. You want to develop the story and projections to convince that lender or investor that their investment in you will be profitable. You understand the questions that they're going to ask. You need to prepare the information before you go knocking on their door. So let's take a look at the business plan. Business plan doesn't really have to be complicated. Many people make a business plan much, much more complicated than it is. But it has certain key roles. It must demonstrate your understanding of the business. And in preparing a business plan, I always like to tell people, well, you can perhaps subcontract out some of the pieces of the business plan, the formatting and perhaps preparation of the financial projections. The lender investor is going to be talking to you. They're not going to be talking to the person who prepared your plan. And they need you to be able to demonstrate your understanding of the business. You also need to be able to show that the loan or investment funds are going into the business, not into your pocket. Ideally, the business plan should project 2 years, 3 years, 5 years of forecasts showing a profitable business. What does the future look like? And is it profitable for the business if we give you money? And what are the critical assumptions we've made to get to that point? The lender investor is going to look at those assumptions and say, are they reasonable? If they're not reasonable, you're probably not going to get the money. They want to make sure that they're going to give you money for some specified period of time. They want to make sure your business is going to be profitable during that period of time. And really, what they're looking for is they're looking for you in the business plan to demonstrate the ability to repay them. Are you projecting cash flow sufficient to make the required payments? You should present your key financial ratios in your business plan. They're going to look at them anyway. Present those ratios, show them to them. Show them that those ratios make sense, which we'll be talking about on the upcoming slides. So how do lenders particularly determine ability to pay? They review the cash flow projections from the business plan. They review your current and projected financial ratios. So they're looking for a current ratio greater than 1.5. They're looking for a quick ratio of at least 1.0. They're looking for interest coverage of 2.0. Fixed payment coverage 2.0. You have twice as much profits as you need to pay your interest or your fixed payments. They're looking for a debt-to-equity ratio that indicates significant investment by the owners in the business. Now, this ratio will vary depending on the type of business. If you're a capital-heavy business where you need a big factory, and there's lots of collateral there, a higher debt level might be acceptable. If you're something like a consulting business with very little collateral to claim, they're looking for a high equity position by the owners. We've talked about in the rest of this course, the calculation of these ratios. This is where they come into play. The lender looks at them. The investor looks at them and says, hey, do you meet our criteria? Next, they look at willingness to pay. So they're going to look at, if you're a small business, they're going to look at the credit scores of both the business and your credit score. They want to make sure that you've traditionally paid your debt. As the business grows, they're going to look at the credit rating of the business. Dun & Bradstreet and some other organizations produce credit ratings for different businesses. If the business is very large, they're going to look at the credit rating from Standard & Poor's or Moody's or Fitch, the credit rating agencies, to determine the credit level of the business. So if it's an individual, they're going to look at you and the business. If it's a smaller business, they're going to look at your Dun & Bradstreet rating. Larger business, the ratings from Standard & Poor's, Fitch, Moody's. They're also going to look at their own experience with this business. What's been our history with this business? Have we loaned the money before? Have they repaid us? If you're a new customer, it's a little bit tougher. If you're an existing customer and you've repaid in the past, the lending institution knows you. They're probably more willing to loan you money in the future. They're going to look at your reputation in the community. That might be talking to different customers, talking to members of the Chamber of Commerce. Lately, we've started to see some businesses sort of look at your online reputation. What are people saying about you in the reviews on Amazon, in the reviews on some website, in the reviews on social media? Your reputation in the community used to be your reputation in the physical community. Now it also extends to your social media community. What's your relationship with the lending officer? Your lending officer is very important because they're sort of your advocate within the lending institution. You need to maintain a good relationship with your lending institution. Your lending officer needs you to help bring loans to the business, but they also need you to be a good customer so they don't get fired. And that's really the last piece here of willingness to pay. The lending officers live or die on their relationships with borrowers. They need you to come to them for a loan so the bank can make a loan, and they need you to be a good customer for the bank so the bank in fact can make them a loan, and they need you to be truthful and honest, because if you're not truthful and honest, you don't have a good relationship with your lending officer, and as soon as they find out that you're not truthful and honest, you're probably not going to do very well in trying to get those loans. But basically, lending officers live and die on their relationships with borrowers. Collateral. Collateral is the property that will be seized if the loan payments are not made as agreed. So basically, collateral is some sort of physical assets that are put up that the lender can seize, take and sell if you don't make the payments. Now, lenders require physical assets. You can't put up your ideas. Well, I have this great idea for a business. The lender can't seize that and sell it. I have this intellectual capital that we've developed in this software. Lenders can't seize that and sell it. So if you're selling ideas, intellectual capital, lenders aren't going to be your best source of money. Investors, however, might be willing to invest in your ideas, in your intellectual capital. Investors are willing to say, well, this person is a smart person, they have a really good staff, they have a really good idea, they have a really innovative product on the drawing board, no physical assets behind it yet, so we might be willing to invest in that. Lenders will say, I can see the potential, but I don't see the physical assets as collateral, so I'm not able to do it. So depending on your type of business, physical assets, lenders are a good source. Intellectual capital, ideas, investors are a good source. And finally, even though you're putting up collateral for lenders, they really don't want your collateral. They don't want the hassle of selling the machinery. They don't want the hassle of selling the factory, just like they don't want the hassle of selling the house or repossessing a car. They really want you to pay as agreed. So what's the cost of financing? Well, from family, friends, and fools, I've got a bunch of question marks. It's sort of whatever you're able to negotiate with your family or your friends, or perhaps with the fools. The rate could range from nothing if you're borrowing from family members, or it could be a high rate, such as 20 or 30%, if you're dealing with family members who are looking to get a return on their investment. So the cost of the money you get from your family and friends is totally negotiable. There's really no established standard. People tend to get money very cheaply from their families, but it can also be very expensive. Contrast that with unsecured borrowings from things like credit cards. The interest rate on your credit card for unsecured cash advances, or for even the money, the startup cost of the business you might charge on your credit cards, can be as high as 20 or 30%. If you get a bank or a credit union to loan you money, the interest rate for a typical business is probably somewhere in today's market between 7 and 15%. Best customers might get the prime rate, which is about 3%. Many businesses do not qualify for the prime rate, so they're getting prime rate plus 2, prime rate plus 4. So they might be at 5, 6, 7% on the low side, and the more risky the business, the higher the interest rate. So a risky business might have a 15% interest rate. Remember, you have to put up collateral to get the loan from the bank at 15%. The unsecured borrowings at 20 to 30, so you can see the more collateral you're able to put up, the lower your interest rate. Stock sale. With a stock sale, you sell ownership in your company, and this is similar to what happens when you deal with a venture capital firm. A venture capital firm is likely looking at a 25 to 50% return. That's sort of a typical baseline for a venture capital firm. A stock sale, the cost of a stock sale is, for an established business, is typically more in alignment with the cost of a bank loan, 7 to 15%. Venture capital firm wants 25. If you're a smaller business where you're getting private investors into the stock sale, it's probably going to cost you less than it would with a venture firm and more than it will cost you with a bank. It's really hard to pin down what the cost of a stock sale will be because they're so variable depending on the type of business, who you're soliciting as investors, if you're a small enough business, or if you're a large business to sell stock in the open market. But as you can see, family, friends, and fools, not sure what they're going to charge you. It's totally negotiable. Unsecured borrowings, 20 to 30%. Banks and credit unions, 7 to 15%. And 25 to 50% for venture capital firms who are taking a significant ownership stake in your company. So what do lenders and investors want? Well, if we summarize, they want to loan to or invest in a profitable business. They want you to come in prepared to have projections and a business plan and to have ratios that meet their underwriting requirements. They want you to come in prepped to talk to them with this information. It doesn't matter if all of the information, every single piece of the information is absolutely perfect. If you come into them prepared with the projections, the business plans, and the ratios, you're in a position to talk to them about it. And if there's things that don't quite meet their requirements, you can talk to them about it and find ways to correct that particular information or find out what their particular hot buttons are, or hot important underwriting items are, and you can work to get those built in a way that are acceptable to those organizations. And finally, lenders and investors want to put their money into the business. They want to put their money into your business. They do not want to put it into your pocket.